Warren Buffett's secret weapon: emotional control in investing. Here's a strange truth about investing. The market doesn't need to beat you. Sometimes it just needs to make you emotional. You can understand stocks. You can study financial statements. You can even identify a great company. But if you panic when prices fall, chase stocks when they explode, or constantly compare yourself with everyone else, your emotions can quietly destroy your returns. And this is where Warren Buffett has an enormous advantage. Not because he knows what the market will do tomorrow. He doesn't. His advantage is that he has trained himself not to react like the market expects him to react. Think about that. When everyone is terrified, he can remain rational. When everyone is euphoric, he can remain skeptical. And when there is nothing attractive to buy, he can simply wait. That sounds simple, but psychologically, it is incredibly difficult. Here's the framework I want you to remember: the emotional investor tax. Every unnecessary decision you make because of fear, greed, FOMO, or impatience can create an invisible tax on your wealth. You buy because everyone is talking about a stock. It rises, so you buy more. Then it falls. You panic and sell. Then it recovers. You buy again at a higher price. You haven't just lost money. You've paid the emotional investor tax. Buffett's approach is almost the opposite. He tries to make fewer emotional decisions in the first place. Imagine you buy a fundamentally strong company at $100. 3 months later, the market values it at $70. A beginner may immediately think, something is wrong, I need to get out. But emotional discipline asks a different question. Did the value of the business actually change, or did the price simply change? That distinction is incredibly powerful. A falling price is not automatically a falling business. But, and this matters, you should also not use Buffett-style patience as an excuse to hold a terrible investment forever. Emotional control doesn't mean refusing to sell. It means refusing to make decisions simply because you are afraid. This is one of the biggest lessons beginners can learn. Your emotions are signals, not commands. Fear can tell you to investigate. Greed can tell you to slow down. FOMO can tell you that you are being influenced by other people's behavior, but none of them should automatically control your portfolio. So, how do you build this discipline? Start before you invest. Write down why you are buying an investment, what you believe it's worth, what could prove you wrong, and under what circumstances you will sell. Then, when the market becomes chaotic, you don't have to invent a decision while you are emotional. You simply return to your original reasoning. Second, stop treating every price movement as news. If you check your portfolio 20 times a day, the market will give your emotions 20 opportunities to interfere with your strategy. And finally, develop the ability to do nothing. This may be one of the most underrated investment skills in the world. You don't have to buy something because everyone else is buying. You don't have to sell because everyone else is selling. And you don't have to have an opinion about every market movement. Sometimes, the smartest investment decision is no decision at all. That is the deeper lesson behind Buffett's temperament. Investing isn't only a battle between you and the market. It's a battle between your rational self and your emotional self. The market will always produce fear. It will always produce greed. There will always be another hot stock, another crash, another prediction, and another person claiming they know exactly what happens next. You cannot control any of that. But you can control whether those things control you. And that may be one of the most valuable assets you can build as an investor. Because in the long run, wealth isn't only built by knowing what to buy. It's also built by developing the emotional discipline to avoid destroying what you have already built.